Welcome to the InterMarket Analysis video update. This is a weekly video where we do look at other markets to see if we can get some clues as to what's happening in the S&P, but I also go through S&P 500 valuation, both on a historical basis and then looking forward. And then I do a pretty extensive study of growth versus value from a number of different perspectives. Typically, when growth is outperforming value, the market goes up. When value is outperforming growth, the market is at best going sideways, if not declining. Value is considered to be more defensive, where growth is more offensive, where you want to buy low and sell high. And as I said, then we look at other markets outside of the stock market, take all of this together and try to see, are there any clues that we're getting by looking at these other markets to ultimately, how is that going to impact the S&P 500? This is being prepared for Monday, August 26th, even though the date is incorrect here. Okay, I do have a thing called the SPXInvesting Program. And if you want to learn more about that, there are links below this video. There are also links that will take you to other videos that talk about the program. It's free for right now, and it's probably going to be free until about October-ish due to some travel plans that I thought were not going to happen that may end up happening. I post additional videos there that I don't post on YouTube or Rumble. Also, if you become a member, right now it's free. You get access to the daily, weekly, and all the different weekly videos right as they're prepared and uploaded, where I delay making them public on YouTube and Rumble. So this can give you a little bit of an edge that way. So please feel free to check it out. Also, the daily video is the real foundation. Now, this is just the InterMarket Analysis video, just one of the weekly videos that are around the outside. If you really want to hone in on what's happening day in and day out, please feel free to check out the daily video. They go public right when the market closes for that day. If you're a member, you get access to it usually 6, maybe 8 hours before the market even opens. The video is really designed for that particular day, but some people still, because they're busy or they just, according to their investment style, they don't want to watch the daily video until after the market closes for that day. But by that point, we're shifting things over and looking at preparing the next day's video. Okay. The first area that we look at is S&P 500 valuation. This is based on historical earnings. And then we do a ratio between price and earnings. And they've come up with these static numbers, 10, 15, and 20, to try to get an idea. Are we expensive, fairly priced, or cheap? Well, you can see here, the black line is the S&P 500, and we've been going back up lately. And we're above this red dashed line, which is a PE ratio of 20. When we're above 20, the market is considered to be expensive or overvalued at that point. We don't use this as a timing mechanism because you can see the market can be overvalued for many years at a time. So you would miss all of these upward moves if you tried to time things based on this. We use it for informational purposes. Then to break it out a little bit, I have this chart down below. This is the S&P in relation to the red dashed line. When we're above 0, that means the S&P is above the line. And it also is suggesting on a historical basis, we are overvalued. This also looks at those same red, blue, and green dashed lines and marks out some major events that have happened along the way, going back to 1980 and what the valuations were at that time. Now, Robert Shiller took the idea of the PE ratio and said, maybe I can develop this into something better, where instead of just looking at the day in and day out PE ratio, why not smooth this over earnings over a 10-year period of time to try to get things so they're more realistic. And so he came up with the Shiller PE ratio, also called CAPE. I've also seen it as PE 10. And then he plots that here. And there's a website where this is available. And currently we're coming in at 36.34. Well, this is what the value has been over time, going way back into the 1800s. And you can see that we're kind of high compared to where we've been in the past. And then also, to get a little bit more context, we look at the median, which is just a little under 16, and the mean, which is a little over 17. And we can see on this basis, we're pretty much double, even more than double the median and mean value over a period of time. So looking at this, the market is also considered to be expensive, but this is also using historical data. The market doesn't do that. This is a chart put out by Edward Yardeni, which plots out forward-looking PE ratios. And this is what the market uses. It doesn't use what's already happened. It's using what it anticipates will be happening going forward from here. And then we can plot that compared to the current price. And in addition to that, this purple line is the mega cap 8, the magnificent 7, the great 8, the illustrious 11, whatever list you come up with. And these stocks are pretty high right now on a valuation basis, but they're also the big earning companies, and they're also the big capitalization companies. And so folks usually don't mind paying more for that. Typically, when these stocks are going up, the PE ratio will go up. When these stocks are going down, the PE ratio will go down. Then we drop down here, and the one that I focus on is the S&P 500 forward PE ratio. And we're getting a little pricey here. We're above 20 right now at 21.1. So even on a forward-looking basis, the market is considered to be expensive. Now, there's other research that I show, I go through in the weekly video. As interest rates are coming down, that may help earnings grow because now companies don't have to put out money for interest. They can plow that money back into their company and potentially make more profits from that. So that may help earnings grow. And that's how these things change. Not only the price of the S&P, but earnings as the forecasts and as analysts come up with their projections, as those are adjusted as well. But right now we're coming in at 21.1 for the S&P. Then we also look at the mid caps, which are coming in at 15.8. They're above that 15 level, so just a little bit above being fairly valued. And small caps are a little bit below 15 at 14.9. So if you were a value investor, you might be looking at jumping into small caps and mid caps, but I wouldn't necessarily make decisions based on that. What are the earnings like for the small caps? I mean, there's a lot of small cap companies that don't have earnings, and even mid cap companies. So you want to take other things into account, but this is, again, just to give us an idea of where are we at on a valuation basis, looking back and then looking forward. Okay, then we go through growth versus value. I first look at a peer growth index all by itself. When the blue line's above the red line, that means we're in an uptrend. So if you look at growth on its own, yeah, it's looking pretty positive. We look at value, also in an uptrend when we look at it by itself. Where it becomes more helpful is when we start to do ratios between the two. We look at a growth to value ratio on top, and even though this is really coming down for a while, it's starting to show a little bit of improvement. And then we flip that upside down because you can see there's an offset here when this moving average crossed over, and they're calculated a little bit differently. And sometimes a little different perspective might help you see something that you would not have seen otherwise. We're down at the bottom. We do have value versus growth, showing how value is underperforming. We do that longer chart here, looking at growth versus value, showing how growth continues to outperform, but it's from really choppy in 2024. Now we look at value to growth, how value has been underperforming. We'll look at some ETFs. Now, when we were really coming down in early August, that's when the market was really having a severe decline a few weeks ago. We're starting to bounce up out of that now. We came all the way down to the 200-day moving average with this ratio, and we're able to bounce up off of that. Here's another value to growth ratio, how value is underperforming. It was showing some strength throughout July and into August. It's since reversed. It's bouncing back up lately. But overall, when you look at the longer term trend, value has been underperforming. All right, then we look at growth again here, another way of looking at this, showing how growth is outperforming value even after some weakness. In a good, solid market environment, when you want to buy low and sell high, we want the growth ratio to really be outperforming value when we look at these charts. We look at a couple of ETFs, and I show this in the daily video, where we were really dropping down below this rainbow. We're starting to improve, but lately we've been coming back down into the rainbow. This is an inverse showing how value is underperforming, even though it was bouncing back up to the top end of the rainbow and now coming back down as well, but it's bounced back up the last few days. We look at small caps all by themselves, a growth to value ratio here, not really showing an awful lot of strength right now. Mid caps also, they were bouncing back up a little bit, but since have been pulling back with the growth to value ratio. This is the one I follow the most because I'm mostly involved with the S&P. We were starting to bounce up with the growth to value ratio, but we're not just really breaking out. We want to see this going up higher than what it's been doing. We also keep an eye on inflation. Up on top is a monthly chart of the CRB index. These are commodities, and we're right down just about at the moving average right now as far as that. And we're below a declining moving average when we do an inflation to deflation ratio. So this just shows that inflation from this type of measurement is declining. Here's a daily chart of the CRB index. It had been doing quite well. It's still in an uptrend, but it's falling below both of the moving averages. The Baltic Dry Index, typically when this is going up, that means it costs more to ship things. When this is going down, that tends to be more deflationary. It's been really, really choppy lately. You could say, oh, some kind of a triangle is being formed here. But for the most part, it doesn't seem to really be a problem from an inflationary aspect right now. Then we just look at other markets where aluminum is in an uptrend, even though it's been falling back. Corn is just going down now, even though it's really delicious to be able to go and get corn and shuck it and eat it. It's that time of year, so it's one of the time I really like. Wheat is also continuing to be in a downtrend. And we look at fertilizer, which has been declining as of late and not really going up or down with any conviction. We want to keep an eye on oil. Right now, it's mainly for geopolitical reasons. It's in an uptrend, even though it's been really choppy. If things start to escalate in the Middle East, the oil price may really spike up. And that's typically what will happen. So far, the market's not really paying attention to what's going on between Iran and Israel. But if that really starts to escalate, oil is likely to go up. Here's a new chart that I've had for a long time. I just haven't been showing it in this video. Gold seems to be what a lot of people are really focused on right now. Well, how does it compare on a ratio basis to oil? Well, lately in 2024, when this is going up, that means gold is outperforming oil. And when gold outperforms, this tends to be maybe some inflation concerns, maybe insanity concerns, instability, maybe economic slowdown. So, plus, it's just been breaking out in and of itself after spending decades of not really doing too much. This is another newer chart. This is the oil to 10-year yield, and you'll see something interesting. Now, I'm not one of these folks that takes a chart and then shifts it forward or shifts another one back, but you could do that with this chart. We look at a pretty strong relationship between the black line, which is the 10-year yield, and the red dash line, which is oil. And you notice how the 10-year yield spikes, comes down, and then after that, oil spikes and comes down. Well, over here on the right-hand side, both are going, well, I should say oil has been going down. The 10-year yield overall has been going up lately. But what we really look at is the correlation on the bottom. When we get a really high reading here, that means that they're going in the same direction at the same time. They could both be going up or they're both going down. The stronger or the higher this reading is, the more correlated they are with each other. And so you might get some interesting perspective here. But you can see that there, over time, there's a pretty strong correlation between the two. We keep an eye on gas, which is starting to go in a downtrend now. Of course, it's an election year, so they're going to do what they can to drive gas prices down, since that's a tax that politicians know you see. And if gas prices are really high, you're likely not to vote for the person who's already in there. Okay, heating oil is also in a downtrend. Natural gas is in a downtrend. We keep an eye on diesel. Now, this is the spot price. Most of the charts we looked at before this are futures. So they're looking out into the future of what they think prices will be at some point down the road. This is the spot price. This means what is the cash price for diesel right now? And it's actually been declining. And this affects 18-wheelers and railroads and things that are transported around. We look at copper, which is generally considered to be a barometer of the economy. When it's going up, they're expecting the economy. This is expecting the economy to do better. Well, lately it's been really falling back. It actually fell down below its 200-day moving average. But now, since it appears at this point in time that the economy is not falling off a cliff, we've been seeing copper start to bounce back up. It's still in an uptrend, but it's really been quite volatile as of late. We'll look at a ratio between copper and gold. Copper has been underperforming gold here on this chart. And then we take that same ratio and spread it out going back to 1980. The red line is the copper to gold ratio. And then to give it a little more context, there's the 10-year yield and the 2-year yield. All of these have been going down now as we seem to be more in a interest rate friendly environment as inflation appears to be coming under control. And the Fed has all but said they're going to cut interest rates in September. We just don't know how much they're going to cut them or if it's going to be beyond that. Everybody has an opinion. We just have to wait and see how it actually plays out. Gold doing quite well. Now, this is the ETF. This is not the futures contract. So it's not necessarily breaking out to a new all-time high, but it is in an uptrend. Silver is also in an uptrend, not hitting a new all-time high yet either. Then we look at the closing price for gold and the closing price for silver up here, and just notice that, okay, probably something that we already knew, but we can look at a chart now and say, oh yeah, I've got some data to back this up. When gold is going up, silver is going up. Correlation shows that they're pretty strong. They're both either going up or down together much of the time. Then we look at a gold to silver ratio on top. When this is going up, gold is outperforming. When this is going down, silver's outperforming. Then we plot the US dollar index because there's a relationship between precious metals and fiat currency. Fiat meaning that it's not backed by anything. It used to be backed by gold until President Nixon changed all that. But we're not really seeing a strong correlation between the top chart and the middle chart right now. So it's really not giving us any real insight. Here's the dollar, which is starting to cross over on the weekly chart, giving us a death cross. Now it's starting to show a death cross here on the daily chart as we're seeing some recent weakness in the dollar, and that tends to help stocks. Here's a longer look here where we broke out above this downward sloping trend line. Well, now we're starting to come back down and break below that trend line. We look at the euro, which had been in a downtrend compared to the dollar for a long time. Well, the euro broke out, and now it's in an uptrend compared to the dollar index. And then the Japanese yen has been in a downtrend, and it still is, but it's bouncing back up as they've been raising interest rates in Japan. You had the whole carry trade thing that folks were doing for literally years, and then that started to unwind, and that freaked everybody out, and it caused a global meltdown that lasted a day or two back in early August, and at least for the time being, that seems to be under control. Then I have a breakout chart here. We finally broke above with the euro. It's now doing better than the dollar on a trend basis. We're still in a downtrend with the Japanese yen to the dollar, but it's really been bouncing back lately. If we keep going up here, we're eventually going to see the Japanese yen cross and give us a golden cross with this ratio. And then the British pound to the US dollar. British pound is outperforming. When all these currencies are doing well, that means the dollar's been going down. Index ratios. I show this in the daily video. The red line is the equal weight S&P, where all stocks are treated the same, versus the bar chart, which is the weighted version of the S&P 500. When the red line's above the bar chart, even though they're on different scales, that just means that the rest of the S&P is actually doing quite well. When this was underperforming, that means just a few stocks were really driving things higher. When the red line's above the bar chart, that means all the stocks are tending to do better. And that's just suggests a more healthy market environment. Then we look at a ratio between stocks and commodities, showing how stocks are outperforming. Here's an inverse showing how commodities are underperforming. We look at another way of looking at the ratio between the equal weight and S&P. When this is going down, that means the equal weight is underperforming. Well, lately it's starting to bounce back up, but this is gyrating around a little bit lately as the market is figuring out, okay, are we going to fall off a cliff economically, or are things still looking okay? Are we going to have a hard landing? Are we going to have a soft landing? And I deal with all those things throughout the various videos that I post. We look at the NASDAQ 100, which is still underperforming the S&P 500. Now, they're both doing really well, but in a really solid environment, we want to see the NASDAQ 100, which are the big mega cap stocks, really outperform the S&P 500. And those mega cap stocks are still in the S&P 500, but there's 503 stocks in the S&P 500, where there's, guess, 100 stocks, at least last I looked, in the NASDAQ 100. We want to see this ratio really going up to be a little bit more positive, but the fact they're still both quite positive and not too far from all-time highs in and of themselves. The S&P 100, the biggest stocks that make up the S&P 500, had been really outperforming, really driving the index higher. That's been pulling back lately, and we actually saw a recent death cross with this ratio, We want to see this go back up to be even more positive for the S&P 500. The NASDAQ to S&P 500 ratio, they both have been doing well in 2024. The NASDAQ was really pulling back. It's still in an uptrend when compared to the S&P, but it would help because the NASDAQ is mostly tech, where the S&P has tech and value stocks and more established companies. But in a more positive environment, we want to see the NASDAQ outperforming the S&P as well. Then we look at the NASDAQ 100, which is underperforming the NASDAQ, which is not how it was for most of 2023 and the first half of 2024. Then we started to shift over here last spring, so I guess not quite half, where the NASDAQ 100 is underperforming the NASDAQ itself. We look at the mega caps, the real monster companies, and compare them with the equal weight. When this is going up, that means the mega caps are outperforming. When this is going down, the equal weight is outperforming. We're still showing an uptrend here with this ratio. But again, to really have the indexes move higher, we want to see this ratio continue to go up. Small caps, complete frustration in 2024. It looks like they're breaking out. A lot of people jump in only to have them reverse and give a lot of those gains back. That's shown by the ratio between the small caps and the S&P. When this is going down, that means the small caps are underperforming. Then it looked like, okay, maybe the small caps were really going to do well, but since then they've been pulling back. They've improved a little bit over this last week. They had a really good day on Friday. I think they were up over 3%, the strongest index in Friday's session. But typically what will happen is when the S&P is really going up, this ratio will continue to go down. We also look at another ratio here. That's the red line between small caps and the S&P, and then the blue line is the S&P itself. In a more solid environment, we want to see the blue line and the red line both going up, but they've been going in opposite directions now since the beginning of 2023. Okay, then here's another way of looking at small caps, comparing it to the tech sector. The tech sector, when it's outperforming, that means this ratio is really going down. Well, we saw that change a little bit in early August. Now it seems to be going back to what it was doing before. The Wilshire, another broad market index, was able to get back above its 50-day moving average. That's positive, and it's in an uptrend. Another total U.S. stock ETF is looking really solid above its 50-day moving average. So this is about as broad market as you can get. Then we look at the advanced decline line here, and we're looking good with the NYSE common stock, the S&P, the mid caps, and even the small caps for right now. Then we look at the big software companies, not really breaking out, not really doing all that much to the upside, but they are in an uptrend on the daily chart. The mega caps, this is what's really been taking things higher. Now, we fell back as we were seeing a decline, but since then, we've been able to get back above the 50-day moving average. The blue line's above the red line, and prices above both. So this is still in a very solid uptrend. Robotics and AI, this is all the buzz right now, breaking out of the rainbow when we look at this ETF by itself. And not doing all that great, though, when we do a ratio between the robotics and AI ETF and the tech sector. It's really been underperforming. It's starting to bounce back up a little bit here, and NVIDIA is included in this, but it's just not outperforming the way you might think it would with all this AI buzz in the air these days. The Dow Jones Composite Average takes the Dow, the transports, and the utilities and puts them together, breaking out and setting a new all-time high. And here is the Wilshire again, which is above its 50-day moving average, but not at an all-time high. And here we go. In case you missed it the other time, here's the total stock ETF. The low volatility stocks. And I'm putting my slides together in a little different way, and so I kind of slip up from time to time. Not even time to time, pretty much all the time until I get this worked out of how it all comes together. These are stocks that folks like to get into when they're concerned about the market going down. And you can see by itself, this is in a really solid uptrend. But when we compare it on a ratio basis with the S&P, it's really underperforming. It started to bounce back when it looked like the economy was falling apart, but now it's been coming back down. Then we look at what's called traditional Dow theory, which you use the Dow Jones Industrial Average on top and the transports. I add the utilities to this. That's not necessarily part of traditional Dow theory, but the three of these seem to go well with each other. And we see where the Dow's getting close to a closing high here. The transports are doing better, but not really breaking out. They've been very frustrating in 2024. The utilities were strong, started to pull back, and now they're making a bit of a comeback here. Transports, very frustrating. Not even backed up to previous highs, let alone setting an all-time high. And we look at a ratio between the transports and the S&P. When this is going down, that means the transports are underperforming. They were starting to outperform here in July and early part of August, but then dropped back. They could be showing some improvement right now, though. And we look at the relationship or the correlation between the S&P on top and the transports, and they're pretty strong, meaning they're both either going up or down at the same time. Doesn't show you the direction. It just says they're moving more in tandem with each other. Then this is another ratio between the Dow and the transports. Been really choppy here lately. When this is going up, that means the Dow is outperforming the transports. When this is going down, that means the transports are outperforming the Dow. Not really seeing anything decisive here for the last few months. Then this is a new look at Dow theory, where instead of using the Dow, why not use the S&P? And instead of using the transports, why not use the NASDAQ? Coming back with the S&P, not too far away from a closing high here. Still have a little bit further to go when we look at the NASDAQ itself. Then even breaking this down a little bit more, instead of using the S&P, why not use the equal weight S&P, breaking out and setting a new all-time high? This is positive because this had been a negative divergence for a lot of 2024 with the S&P setting all-time highs, but the equal weight not doing that. We're seeing just the opposite now. This means more stocks are participating in the upside. And we look at the QQQ, the NASDAQ 100 equal weight, still has a ways to go to get back to its all-time high. Then the FANG index closed right on its 50-day moving average on Friday. Gee, do you think the market looks at these things? And then here's another look, a little longer term. When we were really coming down, I drew a couple of trend lines here, more short term. We broke below that. Then a longer term trend line, we broke below that. Well, we've been able to get back above this longer term trend line and the short term trend line, going up, bounced, came back down to it, but now we're just slightly above that trend line currently. ARC, which has been a real disappointment for a lot of folks. I know a lot of people back in 2020 just sunk everything they had into this, and it's just gone in the toilet ever since, and really has not done all that well here, and it's in a downtrend. Then we look at world stocks taking out US stocks, where they fell down with everything else and then have been bouncing back up. Then we look at a ratio between the SPY, which are US stocks, and compare it with that ETF we just looked at. And this is pretty jumpy right now, but we're a little bit under the 50-day moving average, but still US stocks are trending higher when compared to world stocks. This is another look, a little bit longer term, a monthly chart of the S&P to stocks in Europe, Australia, Asia, and the Far East. We're above this moving average, and the moving average is going up. But we're starting to roll over a little bit here when we look at the momentum oscillator for this. That's a little bit of a concern. Then we look at bonds. This is the price of bonds, the total bond ETF in an uptrend. And then these are world bonds, which finally I was able to take them off the negative slide at the end of this video and put them on the positive side because we're seeing a real recovery in world bonds as well. And this is the 7 to 10-year Treasury bond. This is bonds based on price, holding up quite well as interest rates have been coming down. And this is a bond to stock ratio. And we look at some daily charts here. Then I also look at a weekly chart of the same thing. And then we look at a monthly chart. And when this is going down, it did bounce back up when it looked like things were coming to an end in early August. Now it's been coming back down. But when we look at all the different time frames, stocks still continue to outperform bonds as of right now. This is that monthly chart I was talking about. We're coming down a bit with this ratio, but we're still above an advancing moving average. And these are high yield corporate bonds. You also may know them as junk bonds, setting new all-time highs. These are more conservative corporate bonds, also doing quite well, but still have a ways to go. See, because back in 2020, 2021, there were zero interest rates here. And so these were really doing quite well. They are improving as the potential for interest rates to go down is developing, but they still have a ways to go to get back to these all-time highs. And we'll look at a stocks to bond correlation. And again, this shows that right now they have a fairly strong tendency to go in the same direction. Now, this is stocks based on price and bonds based on price. Interest rates go in the opposite direction. So If bonds are going up based on price, stocks are typically going up as well or down at the same time. This has been kind of an interesting development. We do a ratio between riskier bonds like junk bonds and more conservative bonds like government bonds. And this had been really leading things higher. Well, now we're seeing a real shift as potentially interest rates may be coming down. So folks aren't as willing to get into the riskier bonds to get the better yield. Now they possibly are looking at going out and buying more conservative bonds and locking in a longer term maturity because interest rates may be coming down at this point. And that's when we see this ratio actually falling. Corporate bonds also doing quite well, setting new highs here. And the 10-year yield, nothing really to show here. This is a fib retracement chart. This is a little more interesting. Going back to 1980, where we saw a series of lower highs and lower lows for 40 years. Now we're possibly coming into a higher interest rate environment. At least that's what started to develop back in 2022. We're coming down now as the Fed may be getting ready to cut interest rates, but we're probably seeing what's more the real norm, where this 40-year thing that we saw was more of the abnormal. Okay, then we look at a ratio between the stocks and the 10-year yield, showing how stocks are outperforming. Then we look at the 30-year yield, really not getting all that close to any of these fib retracement lines here. Then we do another ratio, 3 to 7 year bonds compared to stocks. When this is going down, that means stocks are outperforming or bonds are underperforming. We started to spike back up as everything was falling apart in early August, but since we've calmed down with that, this is junk bonds all by themselves. So if you just looked at this chart, you're like, hey man, this looks pretty good. We're in an uptrend. We're above the 50-day moving average. Everything is going up. But when you look at it compared to more conservative bonds, look at how this ratio is starting to come down, and we're about ready to see a death cross here. This is a daily chart of the yields showing how over the last, well, since May or so, we've been falling as far as interest rates are concerned. Then here's a weekly chart looking internationally, also declining with US, UK rates. German rates overall have been declining. Japanese rates were coming down, but then starting to go back up. And that was part of the problem that was caused in early August, was interest rates going up, the value of the yen going up, and this carry trade where people could borrow for zero interest. Suddenly that was all in doubt, and that rattled the Japanese markets. You combine it with the weaker than expected economic report that came out at the beginning of August, and for a few days there, the market was on pretty thin ice, but has since gathered itself back together again. Okay, then we look at the volatility of bonds. That's measured by the MOVE index, and then the volatility of stocks is measured by the VIX. I mostly pay attention to the correlation between the two. And this is not measuring price. This is measuring the top volatility chart with the middle volatility chart. And there is a pretty strong correlation between the two. Then we look at stocks versus 1 to 3 year bonds, short-term bonds, starting to come back out of the rainbow, meaning stocks are outperforming. Then we look at a broad market measure, also compared with short-term bonds. That's the S&P 1500, also starting to come up out of the rainbow. Another broad market measure with 3 to 7 year bonds, a little further out now, also coming up out of the rainbow. The tech sector to 3 to 7 year bonds still having a ways to go, as tech's been a little bit more under pressure lately. And then here's a monthly chart of the price of the 30-year bond, where it's been in a downtrend, but you notice here it's finally starting to cross back above the moving average. So long-term bond prices are starting to show an improvement. Then on the bottom, we show how bonds are still outperforming commodities on a longer-term ratio basis. Then we look at the sectors, and as I always say here, I do this based on the alphabetical list of their symbols. So XLB, B comes first in the alphabet according to all the 11 sectors. So looking at materials all by themselves above their 50-day moving average and in an uptrend, but still underperforming when we do a ratio to the S&P 500. It was starting to bounce back up, pulling back. Maybe it's starting to improve now. Communication, stronger area over the last few years. This is in a solid uptrend by itself, but pretty much going sideways. As the S&P's been doing well, communication is doing well, so we're not really seeing much of a breakout here with this ratio. Energy, which has been under pressure as of late, it's a little bit above its 50-day moving average here, but you can see down at the bottom, the relative strength and the momentum is starting to show some weakness here. And when we compare it to the S&P on a ratio basis, energy is underperforming the S&P. Financials doing strong. And this is, we want to see this. Even if you don't invest in any banks or any different sectors that involve financials, this is good health for the overall economy. And this is breaking out and setting highs with this sector. And also, but the S&P's been doing well and the financial sector is doing better now. This is not what happened back in 2008 when we had the great financial crisis. This was falling off a cliff with this ratio. And so to see this holding up is quite positive currently. Industrials also looking good when you look at them all by themselves, showing some improvement, but still underperforming when compared to the S&P. The tech sector, under a little bit of stress these days, but coming back up to its 50-day moving average and pretty much chopping sideways right now when compared to the S&P itself. As the rest of the S&P has been improving, tech sector has been lagging a little bit, and that's why we're seeing this ratio going sideways. Staple sector, toilet paper, toothpaste. Breaking out here, this is a more defensive area, and we get a little concerned when this really starts to go up. If you notice how this really went up in 2021, right before we had the terrible 2022, well, this is a little bit of a concern right now. But when we do a ratio with the S&P, it's really underperforming. It was bouncing back up, but now it's starting to come back down. So now we're not as concerned as when we just looked at the previous chart. Okay, real estate showing a lot of improvement. It likes lower interest rates because mortgages and equity lines of credit, whatever you are involved with borrowing for real estate, makes it more affordable for folks. So this is looking good by itself, showing some improvement here, but still in a downtrend when compared to the S&P. Utilities really breaking out there for a while, pulling back, but doing better when compared to the S&P itself. And then I usually show the sector chart first. This is another one that's out of order. The utilities, this could potentially be another defensive area, but this could also be a growth area because we have AI, we have Bitcoin mining and crypto mining, and we have all these things that are going to require electricity, and they're getting rid of dams and they're trying to develop new ways of developing electricity. And so there's going to be in electric vehicles. There's going to be real demand for that if all these things end up happening. And so this could be more of a growth thing. But usually when utilities are going up, we are concerned about that because this tends to be more defensive for the market. And then we look at an S&P to utilities ratio. When this is going up, that means the S&P is outperforming utilities. It's been going down and kind of chopping lately as utilities have been doing a little bit better than the S&P. Healthcare, another defensive area. Looking at it all alone, looks like it's in a really solid uptrend. But when we compare it to the S&P, it was bouncing back up, and now it's starting to pull back. Discretionary, the thing that makes life fun, above the 50-day moving average, but underperforming on a ratio basis. And this is a disappointment. This includes things like Tesla, Amazon. And if this could really get into gear and really start to move higher, this would really help the S&P go higher because it's tech, communication, and discretionary, which really drive the indexes higher over a longer period of time. And discretionary has just not played a major role in that in 2024. Energy to tech shows how energy is underperforming the tech sector, even though lately tech's been under a bit of pressure too. Semiconductors, a massive part of the tech sector, came right up to its 50-day moving average and is starting to come back down. Growth, which are growth stocks, buy low, sell high, compared to the price of bonds, was really falling down, now starting to show some improvement. And then we look at it, the tech sector to the 10-year yield, showing how the tech sector is outperforming the yield right now. And then here's an inverse showing how the 10 years underperforming the tech sector. Discretionary to staples. We want to see this going up. It's not. It's actually going down on a ratio basis. Staples, we want this to go down, and it's actually going up. That's more defensive. And then gold to the S&P, not really showing much of a breakout because gold's been doing well and the S&P's been doing well. But on a ratio basis, you don't really have one majorly outperforming the other right now. And then gold has been outperforming the dollar. As the dollar's been under some weakness, this ratio is starting to break to the upside. The NYC composite setting an all-time high here. This is as broad, this is a very broad market measure that we look at, and to have this doing well is very encouraging. High leverage loans, again, above their 50-day moving average. These are very risky loans. If everything was getting ready to fall apart, we would not see this in a solid uptrend like we are. All stocks, which looks at US and international stocks, going back, setting a new closing high here. Emerging markets doing a little bit better as of late. Japanese Nikkei, which really tanked. It fell, what, 12% on the August 5th and then gained 10% back and then 3% more back the next day. It pretty much recouped everything that was lost in that crisis that everybody was talking about, even though they had no idea what they were talking about. But we're coming back up. We're not at all-time highs yet with the Nikkei. These are micro caps, also still in an uptrend. And then this was a concern for a while, but we weren't really sure why. We look at the S&P and the Home Builders ETF. We were seeing a divergence here. We weren't sure if that was positive or negative. Well, it's probably positive now because the S&P was going up as the home builders were going down or underperforming. That's what was causing the correlation to really get out of whack. But you can see here, the home builders ETF just shot up, setting a high now. That's causing this correlation to get back in line. And Bitcoin's right around the 64,000 level currently. And then we're starting to go in an uptrend in China, in the emerging markets, in Europe, Japan, and in the US. So we're seeing globally things are showing an improvement. And here's InterMarket Analysis. Gold is the best performer year to date, followed by stocks and then oil. And then we have the dollar in green here. And then bonds continue to be positive. They were negative up until the early part of August. Then they went back negative. Now they've gone back to positive on the year again. Then we look at some correlations. The S&P 500 to the dollar tending to go in opposite directions. Dollar going down helps the S&P go up right now. We look at another correlation. S&P to oil, opposite directions right now. S&P to the 10-year yield, fairly strong tendency to go in opposite directions. If interest rates are going down, that helps the S&P to go up. Then tech to the 10-year yield, also fairly strong in opposite directions right now. The S&P to the 2-year yield, that's neutral. When we're below the red line and above the blue line, this whole area is, I consider it to be indecisive. Then we look at some long-term charts. This is a monthly chart of the NYSE. We're above the moving average and everything's going up here. And even the Copic curve, which is a momentum oscillator, it continues to go up as well. This is a daily chart of the NYSE, where we look at the NYSE record high percent index. This continues to go up as well. So monthly, we're looking good. If you watch the weekly video, that's looking pretty good. And here on the daily chart, we're looking pretty good. And this is a broad market measure. Here is a monthly chart of the S&P, also looking strong above the moving average. And the momentum, even though it's showing a little bit of weakness here, it is still tending to go up. Here's a daily chart of the S&P on top, and then we look at a ratio of stocks to commodities, showing how stocks continue to outperform. Then this is another look at the S&P to global stocks on a monthly chart. The S&P continues to outperform long-term, but the KST, which is another momentum oscillator, takes a while for this one to shift around. This is still pretty much flat. So then at the very end of this video, I have a positive list and a negative list. And my definition is when the 50-period simple moving average is above the 200-day simple moving average. So when you look at the growth and value indexes by themselves, they are positive. Copper, still in an uptrend, even though it's really been choppy lately. A new one is the euro. So we have the British pound and the euro against the US dollar. And gold and silver are in uptrends as the dollar index is starting to kind of wobble right now. It's just about ready to give us a death cross. The CRB index also showing some weakness, but still in an uptrend as defined by the 50-200 relationship. The big software companies, the mega caps, the FANG index, the low volatility ETF, when you look at it alone, staples, the Dow Jones Composite Average, all of the bonds that we follow based on price. And a new addition here is the Pring World Bond Index. That's been added to the positive side. The tech sector and semiconductors, high leverage loans, the Dow, the NYSE Composite and Wilshire, those are broad market measures that I like to look at. The NASDAQ and NASDAQ 100, the mid caps, small caps, and micro caps, all stocks, that's US and international stocks, emerging markets, and Bitcoin. All of these are in uptrends according to the model that I use here. Pretty short list on the negative side. That's when the 50 is below the 200-day moving average. The Japanese yen to the US dollar, even though the Japanese yen has been improving, and ARK is in a downtrend, which just cannot seem to stay afloat these days. Okay, so thank you. I hope this was helpful to you. This is just meant to be part of the videos that I put out every week. So if you stumbled on this first, please feel free to check out the daily videos or the weekly videos, or just see what, if anything that I post here may be of help to you. So have a great weekend, and I will talk to you in the next video.